Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. I'm not in my usual office. This is my last hooray before the year begins, the school year begins. I'm trying to get all the vacations with my 8.5-year-old daughter out of the way and my wife. So we are in sunny DC. We are actually about 1,200 feet from the White House. We're in this hotel called AKA White House. It's literally around the corner from the White House. Very, very, very cool place. I highly recommend this place for anyone coming to DC. And no, I'm not getting paid for that plug. Just a great, great place. So we're looking at the market. And by the way, I'll be here. I'm leaving tomorrow early in the morning. So I will be here tomorrow for the midweek roundtable. I mean, with my session with Jeff Zananeri. And I will be here tomorrow. I will be here tomorrow for the VIP room, and I'll be there today for the VIP room, so don't miss out. Now, let's get into this analysis. So as you can see here, the Dow is up pretty good. The NASDAQ is up pretty good, about 92 points. It looks like the market's going to open up firm. Now, last week was a crazy week. The bond market, let me just show you what happened on Friday. Look at Friday. All the way from 119.26 to 116. I had an order to sell it near 120, an alert, and we didn't get filled. We didn't get high enough, unfortunately, because look at what happened afterwards. So the question is, why did the bond market start sagging all of a sudden? Because remember, we've been in this range. The reason the bond market is sagging is because jobless claims, and I'll get into the news in a minute, jobless data was really, really, really good. Matter of fact, it was almost twice as good as was expected. They were expecting like 250, 300,000. They got 528. So it was like, or 580. It was a crazy number. So the better the jobless data looks, the more the Fed can press the inflationary button. So that means the market can withstand more inflationary pressure, which is negative for the bond market. And I kind of was expecting that to happen one way or the other. I was expecting the bond market to start cooling off. But I guess I wasn't early enough to the party. I wasn't reactive enough. I wanted it to go up to about 120, low 130s, or excuse me, 120.70, which was like one tick above Thursday's high. Couldn't get it. But here we are, and we may come back. But with this news is very, very actually bearish for the stock market in the short term, because it reinforces that the Fed can, in fact, continue raising rates. So in terms of news for this week, the big, and I mean when I say big report, is going to be the CPI and the PPI. If you recall, the CPI is what Consumers Price Index is what caused that 8.6 is what caused the Fed to just change their plan and shift their agenda. Remember, the core CPI, ex food and energy year over year, this is what the Fed pays attention to. This is what the big number that they look at. So if we can have some evidence that the core CPI is going down, that means inflation has peaked out. And I'm not going to be looking at it I'm not going to be really looking at it on a month-over-month basis. I'm looking at it year-over-year basis. I believe prior was 5.9. Now, if the number is 5.9 or 5.8 or 5.7, that's good for the market. That means things are behind us. If the number goes to 6.2, which I don't think it will, but if it goes to 6.2 or 6 or 6.1, that means we've got worse things ahead of us. That means door number one isn't really very valid anymore, and that means we're going to have a major rebalancing once again, with commodity stocks starting to shift, tech stocks starting to shift. So this report is going to be very, 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 very instrumental. On a year-over-year CPI, which is interestingly, they're looking the number to come down. So I'm curious why they think the year-over-year is going to come over without the food and energy, where food and energy has been going down. But what do I know? But the bottom line is I'm looking for the CPI to start cooling off, and that would, in fact, confirm that the worst is behind us. Remember my analogy, door number one, door number two, door number three. Door number one was the worst is already behind us, so we're right in there. We're about 60% done. That's kind of the bond market is doing that. Door number two, doom and gloom. We're going to crash and burn. We were only about 50% done with the market. And door number three, recession is too far away to really care right now. So this will give us a much, much better idea of where we stand, and then that's going to be followed by the PPI, and the PPI is not as an important number, and then consumer sentiment, which would be really important if it came out before the CPI, but it's actually coming out after the CPI and the PPI, so it's not going to have that much of an impact. Let's talk a little bit about global economy and then get into technicals. U.S. job data cleared the way for more interest rate hikes, and Chinese exports rose by double digits. That's the headline number. Government data showed employers added more jobs than expected in June, by like double as much, okay? I guess people are scared of this recession. China's trade surplus swelled to $101 billion in July after imports rose to 2.3% year over year, reflecting weak domestic demand. But China gets most of its demand from across the world, so I want to see how that shakes out. Markets have been rattled by Russia's war in Ukraine, which caused a spike in oil prices, wheat, and other commodities, and by uncertainty about China via disruptive manufacturing and shipping, starting all the way from COVID. And last week's strong unemployment data gave the Fed officials who say the economy can tolerate higher borrowing costs to cool inflation. After Friday's announcements, traders expect the Fed to raise its benchmark by 0.75, and that's what they were expecting them to raise by before that happened anyway. But honestly, if they even went to 1 right now, I think the market could handle it. Wall Street is coming off of its best month for stocks since late 2020, a rally driven by falling bond yields. What did bond yields do on Friday? They went back up. Traders hoped the economy was slowing enough for the Fed to ease off. It's not. Now, the bond market, I'm expecting this bond price to go lower and yields to rise, continue rising. I know we're a little bit up right now, but I don't think that's going to remain that way. As far as sectors are concerned, we have to respect our CSI scan, utilities, energy. Technology, look at where technology is and look at where consumer discretionary is. Fragmentation means overbought. Very strong chance we're going to see downside on technology and consumer discretionary and more upside on the healthcare stocks and consumer staples. If you look at utilities, they look like they're basing right now. If you look at energies right here, they look like they're ready to go higher. Technology, on the other hand, looks like it can be a little too much too fast. Consumer discretionary's already had a bearish day on Friday, but look at healthcare. Healthcare is still choppy. Industrial's looking good. I like that. Real estate is looking good, but honestly, consumer staples is looking good. But I would be very, very cautious right now. I would be very cautious with communication services. I would be very, very cautious with technology, and I would be very, very cautious with consumer discretionary, which have already started cooling off, and communication is already basing out. So be very, 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 very cautious right now. In terms of the Dow, let me just kind of show you what I'm looking at. In terms of the Dow Jones, which is up quite a bit, I'm still very much concerned with whether we're going to go above this 8.6. This is when CPI was 8.6. So I'm really nervous about that. And on the QQQ, we went above that hump. I think we're going to come down into this range and start basing out back within here. Let me just kind of show you this. I think this is too much too fast, and it's going to cool off, and it's going to put us right back into this base. And we're going to see a lot more selling pressure in the NASDAQ than we will in blue chip stocks over the next few sessions. Now, earnings. We're coming off of the big stuff, but we still have 3D systems. And here's the estimates right here on the right side. You got Barrick Gold today. You've got Dominion Energy. You've got Fresh Pet. You've got Lemonade. You've got Marriott. You've got News Corp, Noble, Novavax, PLTR. You've got Take-Two. Smaller companies, Tyson Foods. This is going to be an interesting one right here, 197. Tomorrow, the big report is going to be Coinbase. They're reporting a loss of $2.68. Revenues projected to be down 53%. These are pretty negative numbers. And last time they had a profit of $6.42 profit. Now they're looking for a loss of $2.68, and that may be in line with estimates. Tomorrow we've got Bloom Energy. You've got Emerson, You've got H&R Block, Hyatt Hotels. That'll be a very interesting one. Norwegian Cruise Lines. Can't wait for that one. Planet Fitness, Plug, Ralph Lauren. So you still have quite a lot of airlines. Spirit's coming out tomorrow. That'll be an interesting one for travel. And as I mentioned, on the right side, you could see what their estimates are right here. The Trade Desk is on there. Warner Music, Wynn Resorts. That'll be very interesting. So we still have a lot of big companies to report, and I'll be updating you how everything is doing and give you the cumulative before the end of the week. Now, folks, I'm expecting some turbulence, and I'm expecting some downside from tech and consumer discretionary stocks. So hold on to your seatbelt, expect bond yield to go a little higher, volatility to expand, and markets to start reverting back to it not being the best time since 2020. Last month was the best month since late 2020. I don't think August is going to be a repeat of that. I really don't. So be cautious, be nimble. This is not a time to be a hero. Let's see how August treats us, and if we can get out of this and bonds can rally in one piece, then we know the worst is behind us. But I won't know that till CPI and PPI comes out. So we've got to be really, really careful beginning of this week. Now, folks, if you haven't yet, you need to check out something really, really, really special that I put together for you. It's a training that covers 5 simple patterns that historically work extremely well and have helped me go 11 for 11 since I started using the strategy and started using and issuing signals on the strategy. I go into all the details of how you can spot the patterns yourself and even get alerted when patterns show up on a stock chart. Not every trade will be a winner. We all know that. But of course, obviously, we're not miracle workers here. But it really has become my favorite way to trade individual stocks in this current market cycle. It's pretty great. Before I even entered the trade, I know how often similar setups in the past have led to winning trades. So I get to know the historic profit factor and the historic win rate. Now, it won't tell us if we're going to have a winner in the future, but it gives us a lot more clues than you typically get when you put on trades. Follow the link below. Check out these 5 patterns right now. Do it now. It's important. Pay attention to this week's CPI and PPI. Very important reports, and more importantly, how the speculative and the main sectors react to it. That's going to be huge. I'll talk to you all tomorrow. If you're enjoying these videos, if you're getting value out of them, if I'm helping you survive in these markets, send me an email. It doesn't cost you anything. support@marketgeeks.com or comment below this video. If you're watching on YouTube, find the link in the descriptor. Bye, guys. Have a great, great Monday. I'll see you from Washington, D.C. Hopefully I won't run into Biden or Pelosi. Don't get me started. Bye, guys.